this is Joseph, and welcome to my November FOMC debrief. So first, I'm going to level set as to what happened since the last meeting. Secondly, I'll talk about the market's reaction to today's meeting. And lastly, I'll talk about a few things that I found interesting. First, let's level set. So the last time we had a Fed meeting was in September, and September was one of those special meetings where we got a dot plot. The dot plot at that time guided towards one more rate hike this year. But between then and now, some pretty important things have happened. Specifically, we've seen longer dated treasury yields rise significantly. The 10-year skyrocketed to 5%, and during the intermeeting period, we had a few Fed speakers point towards the rise in longer dated yields and note that financial conditions have tightened, and to some extent, that may substitute for further rate hikes. Now, heading into today's meeting, the market was not expecting any Fed action today, and indeed, the market only prices in some probability of another rate hike in December or early next year. What I think the market was most interested in understanding today was how Chair Powell was thinking about the rise in longer dated yields, since that, I think, holds the key to the future path of policy. Now that the meeting is over, when we look at price action, it's pretty clear that the market interpreted this meeting to be dovish. Now, if you look at short-term interest rate futures before and after the meeting, you'll note that after the meeting, market participants guided towards, priced in, a lower expected path of Fed policy. So the market is less convinced of the strength of the higher for longer mantra, which the Fed has beat into the market over the past 2 years. Now, if you look at other assets, that seems to confirm what we're talking about. So the dollar, seemed to be slightly stronger earlier in the day and weakened heading towards the end of the session. Equities, zoomed higher, but note that when you're talking about days like this, there's a lot of, options hedging activity that seems to create upward movement in equity prices. So as later on in the week, we'll see if this sticks. But across a wide range of assets, it does seem that the market interpreted this meeting to be dovish. Now, turning to what actually happened at the meeting, for me, I thought was most noteworthy is that Chair Powell actually gave a very clear framework as to how he's thinking about the rise in longer dated treasury yields. Let's hear it from him.
As long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. If things are fluctuating back and forth, that's not what we're looking for. With financial conditions, we're looking for persistent changes that are material. The second thing is that the longer-term rates that have moved up, they can't simply be a reflection of expected policy moves from us. That we would then, that if we didn't follow through on them, then the rates would come back down.
So basically what he's saying is that if longer dated yields stay high, he's probably, not thinking that he needs to hike rates anymore. Now that's totally fair. As we know, the 10-year yield has been moving around a lot. It moved up above 5%, but now it's markedly below it. My sense is that even where it is today, let's say 4.7%, that's a lot higher than it was in September. And that's still, I think, meaningfully tightening financial conditions. And as I've talked about over the past few weeks, I don't think the Fed is going to hike anymore. And I continue to believe that cutting is more likely than expected. But the big man himself, of course, is not talking about cutting at all. He reiterated throughout the press conference that he's still trying to figure out whether they need to hike again. He is noting that policy is restrictive, but he's not sure if it's sufficiently restrictive. So he's definitely keeping open the prospect of further rate hikes. Now, the second thing that I found interesting today was that Chair Powell doesn't seem to be as certain that he needs a softening in the labor market to get inflation back towards target. Now, over the past 2 years, Chair Powell has been basically looking for weakness in the labor market. In his mental model, he seemed to suggest that we need to have the unemployment rate go higher, which of course will make wages go lower, and that will help inflation get back towards 2%. In previous Fed conferences, he had cited approvingly former Chair Bernanke's work on the subject that seemed to support this. And it's totally reasonable. After all, if wages are rising at 5% annual rate, then it's hard to see how inflation would be back to 2%. In fact, the FOMC, well, important members of the FOMC even created their own supercore measure of inflation, which is basically services x housing that is highly influenced by wages to point towards the need to have a softer labor market. Now, this theory all makes sense, but the fact is, over the past year, we've had inflation steadily move lower, and yet the unemployment rate remains very low. So the facts seem to challenge the narrative that you need a softening of the labor market. And Chair Powell mentioned that, well, labor participation rate has increased and we've got more immigration. Basically, wages can also soften by an increased supply in labor. So maybe we don't need to have a labor market crack. Maybe we could just continue to increase the supply of labor. And so he doesn't seem to be as committed towards that. And again, on the margins, this is dovish because we don't need to wait for a crack in the labor market before we start thinking about rate cuts. Now, the last thing that I thought was interesting, of course, is the question whether or not this rise in longer-dated yields means that the Fed is going to have to adjust its quantitative tightening program. Now, no doubt, QT increases the supply of treasuries that the private sector has to absorb. So that is definitely having an impact on yields. How much? Hard to say. But Chair Powell was pretty resolute that they're not really thinking about changing the QT program, and I don't expect them to. Not until, of course, we have some serious action in the market, which, today, after today's Treasury funding announcement, seems less likely in the near term. And of course, I'll talk about this at my weekly markets review. And so that's all I have to say about that. It was, actually, it was more interesting than I thought it would be. All right, talk to you guys this weekend.